very interesting comments there from the Reserve Bank Governor, Adrian Orr. And a couple of things he noted. I mean, there's the ongoing discussion about how much inflation is imported and how much of it is generated internally. He did note, and I've certainly picked up, that we had I think he said one of the biggest fiscal responses in the OECD, and also we've had one of the biggest house price increases in the OECD. In fact, around the world, is wider than the OECD, one of the biggest house prices increases over this period. So the question is the bank in the exact right space, which seems to be Adrian's view, which I suppose is understandable if you're the Reserve Bank Governor, or we should be doing something differently? And we now have three panellists who are able to help us with that discussion to no end. So we have firstly Sharon Zollner, who's the Chief Economist of our biggest bank, the ANZ Bank. We have Grant Spencer, former Deputy Reserve Bank Governor and Acting Reserve Bank Governor when yours truly was Finance Minister, and also currently the Adjunct Professor in Economics and Finance at the Victoria University of Wellington. And live from London, and thank you very much, Charles, for giving us your time at this time of the evening in London, Professor Charles Goodhart, who's the Emeritus Professor of Banking and Finance at the London School of Economics. So a very illustrious panel. The plan is, team, that we don't do too long in the prepared comments. You know, you've heard me on this already. 5 to 7 minutes to lay out your stall as to what you think we are up to and what we should be doing, and then discussion for about the second half of our session. So, Sharon, you've drawn the short straw, so you get to go first.
Thanks very much, and thanks for inviting me to be here again today. So I guess I'll step right back here. How did we get here? And I think there is an emerging consensus on what happened, and that is that when COVID hit, it was widely thought that it would be a rerun of the GFC to some extent, insofar as that it would be a big net negative, long-lasting hit to confidence and spending, and that therefore both monetary and fiscal policy should do everything they possibly could to shore up demand. And that while there were obviously consequences for the supply side of things, that those would be relatively short-lived and sort themselves out pretty quickly, because that's what capitalism is good at. However, what we've seen, of course, is the complete opposite, that with the very able support of both monetary and fiscal policy, what we had was a series of very short-lived demand shocks, whereas the hit to the supply capacity of the world and the ability to move goods around, all that sort of thing, has been extremely long-lasting and is showing no signs of getting better at all. It's still getting worse. And so, of course, that is a far, far more inflationary mix. And it's obviously problematic that policymakers got it wrong. They were alone in that, though. I mean, we were also waiting for the other shoe to drop, thinking, not believing our own business surveys. Businesses were telling us that we were in one heck of a V-shaped recovery. We're going, but we've had a national income shock. We're all poorer now. How can we possibly be all spending like we've won lotto? And yet that's exactly what happened. We had incredibly strong retail spending, underpinned by the very, very strong performance of the New Zealand housing market, with house prices up 40% since COVID hit, which is quite something. And of course, we now sit here with much higher government debt and higher household debt. Businesses, however, have been pretty prudent. So they're not quite in the same boat as some countries where every sector has leveraged up. But nonetheless, we are sitting with a heavier debt load than we had before, and much higher asset prices. So in New Zealand, it's mostly about housing, but this has, of course, been a global phenomenon. So whether you're talking about equities or Bitcoin or some of the more obscure cryptocurrencies or non-fungible tokens, people paying $1,000 or more for the ownership of an anime picture, which is this different from this other one that's for sale for $10,000. You know, people are buying investments that they don't understand even necessarily what they are or what they're for or what the risks are around them. That has definitely been a theme of the last couple of years. It was emerging before that, but obviously the easing in monetary conditions, the massive surge of liquidity really did put the fire under that. We've been here before and it didn't end well. And so I think there does need to be some kind of reckoning in some pockets of asset markets where risk has been severely mispriced for a very long time. And of course, the party's been able to continue as long as central banks are your friends. But central banks are now backed into quite the corner. US inflation's already 7%. New Zealand inflation could well end up there, given what's happening to oil prices now. And so in that situation, there is really only one mandate that counts. Everything else is a nice to have. And so with supply shocks, there are unpleasant trade-offs that central banks have not had to face for a very long time in terms of stabilising employment and output versus stabilising inflation. So you can see that in the forecast. The Reserve Bank is forecasting raising the official cash rate steadily as house prices fall. So that's unprecedented. And so the question is, having had this boom globally, can we now solve this inflation problem without a bust? Is there a forward path for the official cash rate that will bring inflation back to target in an acceptable time frame without causing a hard landing in the housing market and in the economy more broadly? Because obviously the housing market is extremely important for the New Zealand outlook. We're all forecasting exactly that. We're all forecasting a soft landing, that the Goldilocks scenario, it's still not great, but it's the best of a bad lot, where the economy does struggle. We've got supply constraints, most obviously the supply of labour, but it really is across the board. Jib board would be another pressure point, but they're all over the economy. So we're going to struggle to deliver strong growth in that environment. We've got rising interest rates, falling house prices, 6% inflation. There's a massive cost of living impost on households. That's not a great growth picture, but we've got the Reserve Bank raising rates throughout, because that's the reality of what you get with a supply shock. Our forecast for a soft landing, that would be pretty much unprecedented, that central banks managed to beat 7% inflation without a recession somewhere in the mix. So perhaps that's a good segue to Grant Spencer to talk about what he thinks the Reserve Bank should be doing from this rather awkward starting point. Thank you.
Thank you very much, Sharon. There's lots of points there we will come back to. And you're right, we will go straight to Grant, who's in the interesting position of, after a long period of time at the bank, and now an observer of the bank, an observer of the monetary policy responses of central banks around the world. So, Grant. Thank you.
Well, thank you, Stephen, and thanks, Sharon. It's a pleasure to be here. I'll make 3 points. The first one is that I do think monetary policy has been easy for too long, and the Reserve Bank does need to move faster in this tightening cycle. Inflation's the highest it's been since 1990. It's across all the main CPI components. And so there is a real risk that inflation's going to become embedded in expectations and become very difficult and costly to remove down the track. And as Sharon mentioned, with the further pressure on oil prices, that's just going to make it even more difficult. Now, the bank, was, relatively speaking, an early mover with its first tightening in August last year, but it's still been slow. It's just been a bit faster than other central banks. It's expecting to still really have its foot on the accelerator up until the end of this year. In other words, it's not expecting to get back to neutral until the end of this year. So that's not a good place to be. If you've got a really serious inflation problem brewing, you should be moving back to neutral more rapidly. That is what's going to reduce the regret of an embedded inflation problem. My second point is that if the bank does move more promptly, move faster, I think the overall tightening, the overall increase in the OCR in this cycle may not need to be huge. And it may not need to be as high as the terminal rate of 3.4% that the bank indicated on Wednesday. The fact is, some of these touched on by Sharon, is that, a very high level of debt at the starting point in the private sector, particularly in the household sector, so that any increase in OCR is going to quickly erode discretionary incomes. We've got the weakening housing sector, the housing market, and we know there are a raft of factors affecting housing apart from the higher interest rates. So that's going to reinforce the impact of the tightening policy. And thirdly, the synchronisation of global monetary policies. So, if the Reserve Bank actions are going with the global tide, they're going to be a lot more effective than when they're going against the tide. So, I feel that if the bank does move promptly, the terminal rate could stay between 2.5% to 3%, rather than being north of 3%. If you're getting north of 3%, that's the situation where you're going to have embedded inflation as a problem, and that risk of a hard landing that Sharon was talking about is going to be greater. The third point I wanted to make was around the unconventional monetary policies, quantitative easing, credit easing. So in our case, the LSAP program and the funding for lending program. In my view, they can have benefits in the short term, but bring significant risks and distortions the longer they're left in place. The main risk is that governments come to rely on monetary financing of their fiscal deficits, and the distortions is the undermining of the fundamental drivers of term interest rates, which are the demand and supply of loanable funds and expectations. So while these policies may be used in a crisis or an extreme situation, they should not become mainstream monetary policy tools. If we look at the LSAP, I think the bank has sensibly winding that up. It called a halt in July last year, and on Wednesday it announced the total zeroing out of government bond holdings on the Reserve Bank balance sheet over 5 years. I think that's a reasonable approach, and so I would support that. On the other hand, with the funding for lending program, this program is in fact more interventionist than quantitative easing, because it's a subsidy, it's a lending subsidy, in this case to the banks. And when you're normalising policy, I would think that should be the first policy removed, not the last policy removed. And the bank has that not finishing up until December this year. So that remains a bit of a mystery to me. But my essential point here is that the unconventional policies can be useful, but they should be seen more in the stabilisation, lender of last resort category, rather than being adopted as mainstream policies. So back to you, Stephen.
Thank you very much, Grant. We may come back on the funding for lending program and of course other elements of your comments as we proceed. To get the full picture, we're going to now take Charles Goodhart's view from London. Charles has been a friend of this country for a long, long time. He's had a relationship with the New Zealand Reserve Bank going back many years, and senior staff of the bank. And although it's fair to say in preparation for this, we've been giving him a quick, catch-up on current situations in this country, obviously probably helped by the last two speakers and their comments. So, Charles, with that in mind, we'd really appreciate your thoughts from a more international perspective.
Thank you very much. I'm very glad to talk to my various friends in New Zealand. I'd like to start by saying that the Governor is absolutely right when he says both that all central banks have really followed exactly the same kind of policies, facing the same kind of conditions, and that New Zealand is not unique in this respect in any way. And what is more, that the Reserve Bank was one of the very first to realize that there was a need to stop the massively expansionary monetary policies that all the central banks had followed. Nevertheless, I think that 2021 is going to come out as a year when all the central banks, including the RBNZ, actually got it wrong. And they got it wrong by not seeing the persistence and strength of the inflationary pressures that were getting in place. I could actually illustrate that by saying that one of the standard approaches to trying to decide what kind of interest rate was appropriate is the Taylor rule. And the Taylor rule says that you ought to raise interest rates, nominal interest rates, by more than the increase in inflation over the target level, and by the degree to which your unemployment is below the sustainable rate. Now, if you do that for New Zealand, I haven't actually done the figures exactly. My guess is that what you would get would be that the Taylor rule would suggest an interest rate of somewhere between 6 and 7%. In other words, double the sort of 3.4 that people have been talking about as the neutral rate. Well, okay, this is because there's been a supply shock, and it's oil prices and it's supply shocks and this, that, and the other. But I am reminded very much of how we got into the stagflation conditions in the 1970s. There was an oil shock in the 1970s after the Arab-Israeli war, when some of you who are older like me will remember that oil prices doubled, quadrupled, went up 4 times, a much percentage higher increase than we're likely to see now. And a lot of countries and a lot of monetary central banks thought that because this was temporary, you should look through it. The problem with that is that when you get a sufficient increase in prices, that it actually reduces people's living standards and they don't like it. And if the labor market is strong enough, they will seek and demand higher wages in line. And there was a difference between countries which had tried to absorb the Arab-Israeli oil shock, like the UK and Italy, which got into an inflation price spiral, and Germany, which said, well, we mustn't accept this because we have got to keep the demand down so that we don't hit a wage price spiral. Now, again, you're talking about the decline in housing prices. But when you've got inflation rising faster than the rate at which nominal interests are going up, real rates are going down, and people will think that actually the cost of borrowing in real terms isn't rising yet very much. Okay, so that rises in nominal interest rates will have an effect, even if real rates are still very low and for the time being declining. And given what's been happening to oil prices and gas prices and will happen to wheat prices and food prices and fertilizer prices, the likelihood that inflation will rise even further over the next 3 months is almost baked in. And rising nominal interest rates at 25% when inflation is probably going to be rising at 50 basis points a month is not what you might describe as particularly strong. Finally, the governor and sort of the general consensus was, okay, we're going to go back to neutral. Well, Alan Blinder is just writing a book looking at how the Fed tried to deal with inflationary spikes over the years since 1965. And in most cases, not all, but in almost every case, you actually needed interest rates well above neutral, and you had to have possibly a short recession in order to bring the inflation spike back, even if the initial cause of the inflation spike appears to be simply temporary. because you cannot allow a wage price spiral to develop. And the idea that people will go on believing in that inflation will come back to low levels if inflation goes on rising for a few quarters more is, I think, somewhat wishful thinking. Central banks are in a horribly difficult position. On the one hand, if they don't do enough, inflation will get embedded. On the other hand, if they do too much, anywhere, and that's not only New Zealand, it's anywhere in the world, we could have an asset price collapse leading to a recession, which would do no one any good. Trying to get a soft landing under these conditions is actually rather, it's an analogy I didn't make myself, but I think it's rather a good one. It's like trying to land a 747 on the deck of an aircraft carrier. You know, one little slip either way, and you're in the soup, either inflationary soup or recessionary soup. I wish every central banker and those of the monetary committees the best of luck in an extraordinarily difficult situation. And I think they will need a hell of a lot of luck to get out of this without their reputations being in difficulty.
Thank you very much, Charles. And I think we should probably credit former Prime Minister Bill English with that, New Zealand former Prime Minister Bill English with that saying, because you and I discussed it earlier in the week and we agreed that it was quite a good one for the current scenario. Before we go back to the rest of the panel, I have a question for you. It's been head-scratching for me just how slow the Federal Reserve has been and just how little debate there was in the US beyond, I think, Larry Summers about the inflationary effect of the Biden stimulus package soon after he was elected. Are we in a situation where people have forgotten the lessons of history, and does that include the Federal Reserve, for example?
I think it does. People are really quite myopic. And on expectations, you will expect what you had in the recent past. They're not particularly good at looking forward. The idea that markets and sort of swaptions and options are a good predictor of what's going to happen in the future. The idea that the difference between index-linked and nominal bonds are a good predictor of what's going to happen in the future, that's for the birds. We can't foresee the future, and we have to be much more quickly adaptive to current conditions. And the belief that central banks have somehow credibly anchored inflation expectations and therefore everything will come back to normal, I'm afraid it's just wishful thinking.
I want to bring in the rest of the panel now, if I could. There's a great old saying which comes from, I think, the last inflationary period, is that monetary policy needs friends. And the question we have now is monetary policy being complemented by other government policies, or is there work to be done there? I think governments around the world are trying to sort of contract out all responsibility for inflation to their respective central banks. In the New Zealand context, we have Minister Robertson talking about further increases in spending in this year's budget. And we also have a government talking about further constraints, notwithstanding, of course, the very big constraint at the moment of COVID and the borders, but talking about tighter immigration policy going forward than it has been in the recent past. Are we in a situation where other government policy is going to make the Reserve Bank's job harder to achieve that Goldilocks landing, if you like? Let's start with Grant.
Thanks, Stephen. Yeah, well, those other policies are very important. I think from the point of view of fiscal policy per se, we heard Carolee yesterday. And so even though spending has increased and is staying at a high level, the actual fiscal impulse apparently is starting to come off. So the fiscal impulse, because the economy has been strong, the tax take has been great, the deficit hasn't been rising as fast as expected, that fiscal impulse is not a big counterweight to a tightening monetary policy. But, you know, the other policies you mentioned, the sort of ones that affect the supply side, clearly housing supply is an important factor where the government is making some contribution there. And the other very important one that you just mentioned, migration, that clearly is going to play a major role in terms of these supply side pressures. So if you're looking to ease the supply side pressures, the freeing up of migration is probably the biggest factor, the biggest contribution they could make.
Okay. Sharon, what's your view? Should the government be tightening its fiscal response at this point?
Well, in a pure macroeconomic monetary policy friend perspective, probably yes. But one of the unfortunate consequences of this pandemic has been widening inequality. And so it's pretty difficult to say there isn't a role for government to try and address that. But then insofar as you're supporting incomes and trying to boost spending power, then you are working in exactly the opposite direction to monetary policy. But then you start getting into the question of, well, who is going to pay the price for solving inflation? Is it going to be businesses who find it harder to pass on price increases and wear it in their margins? Is it going to be minimum wage or low wage earners who don't get perhaps the wage increases that others might? Or is it going to be highly indebted recent home buyers? You know, the choices that monetary and fiscal policy make will determine to some extent who wears the cost of that. And what we have seen, unfortunately, in the last 2 years is that those the more vulnerable members of society have worn quite a lot of it. And also the younger generation. They're the ones sitting there with the fiscal debt. They're the ones who have paid through the nose for houses. And so you have to take that into account as well. Unfortunately, they're not a very large voting bloc, and they seem to be a little bit apathetic about voting. But I do think that that's something as well that fiscal policy needs to take into account. But in a broader picture, we've got the big numbers, but we don't yet know what they're going to spend it on. And in such a capacity-constrained economy, I think that's going to matter a huge amount in terms of how much inflationary pressure it adds.
Charles, what would be your advice to the government of the day in probably any country, I suppose, in terms of where they should be going with their fiscal stance now and their other microeconomic regulatory policies? Because it feels to me we're still acting to some degree as if inflation is not the very significant problem that it is.
Well, again, New Zealand is not alone. It's not unique in any respect. On immigration, the population, and particularly the working age population of the UK and the US, would go down from here on if it wasn't for immigration. The only way that we're going to get an increased supply, particularly, and this is something as an old person I feel very strongly about, of care workers. The proportion of old in our societies is going to go up by leaps and bounds. It's not something that most of the people, at any rate in the UK, actually want to do. We don't get immigrants in to help us with it. We're going to have a crisis of lack of care of the old, and also a massive great increase in wages for those carers. So on immigration policy, a lot of countries are going to have to struggle with this particular problem. It's not just New Zealand. It may well be that attitudes towards immigration in the countries at large will have to change actually quite dramatically. One of the other things that I would advocate is that prices of energy, petrol, gas, and so on are going to go way up. One of the things that I would suggest is that when these prices, as they will, start coming down, that you keep the domestic prices high in order to deal or help to deal with both climate change and the fiscal problem, both at the same time. So that I would hope that ministers of finance simply don't allow the subsequent decline in energy prices, which will come, to bring about a decline in CPI. take the opportunity to raise taxes and keep pressure on reducing fossil fuel usage.
Okay. Folks, I want to move to the impact of ultra-loose monetary conditions on asset prices. And then, of course, the flip of that, which is the potential for a rapid downward trend in asset prices now. In the New Zealand context, as Sharon's pointed out, it's through the housing market more than anything else. Early on in the pandemic, the Governor Orr was making quite a virtue of the fact that one of the great things about ultra-loose monetary policy was people felt wealthier because their house price was going up and their asset prices were going up, and they could therefore feel confident about borrowing more. Earlier this week, he was distancing himself from that and saying, well, they should have been more careful, potentially, if interest rates are now going to go up. So sort of a little bit of having your cake and eating it too. But nevertheless, one of the things that strikes me is we've had a long discussion in this country about house supply and the impact of various factors on house prices. But certainly in recent times, it seems that no immigration, large numbers of housing consents and building going on, that we've really been driven a lot by low interest rates. That's pushed people to perhaps pay more than they would ever pay previously in the housing market. Have we got a problem here that as rates go up, get to 3.5% in the bank scenario, possibly more than that in Charles's scenario? I mean, how are people going to feel if the impact is less equity in housing and a drop in housing prices about the whole monetary policy construct? I mean, this is a big deal, isn't it? Isn't there a political dimension to this in terms of the impact of particularly first home buyers? So I don't know who I'm going to throw the ball to first, but let's start with Grant on that, and then Sharon.
Well, you're right, Stephen. Housing, whether we like it or not, has been one of the main, and probably the main, transmission channels for monetary policy for many years. I'd say the other main one is the exchange rate, and both of them can cause problems from time to time. So, yeah, when with the initial easing of policy, a lot of the impact was generated through increased wealth, increased house prices, increased wealth. People feel more confident, better off, and they go out and spend, and aggregate demand is boosted, and and the policy has effect. So all of those sort of side effects related to equity and difficulty for first home buyers, etc. But basically, the Reserve Bank sort of sidelined those and tries to play them down, even though they realise, they are real issues. They're unintended, distributional effects, for example. But monetary policy is not a perfect tool, and that's the way it has its greatest leverage. As you say, in the reverse scenario, now where we're headed down the other side, a lot of those effects are going to be unwound, and there's going to be a lot of discomfort for people, existing homeowners, but maybe some of the first potential first home buyers lining up, the younger people, may feel a little bit better that maybe housing is within reach after all.
Sharon, I'm conscious that you're in the sort of front line of this, given that you're the chief economist for New Zealand's largest bank. So I imagine you'll step carefully through this minefield. So what's your read, and should we be worried, probably as policymakers, if you think about this debate? I mean, one of the things I worry about is whether we take asset prices into consideration sufficiently in monetary policy decisions. So maybe we can go a bit broader.
Yeah, that is a thorny one because bubbles are hard to identify in real time. But I think there's a fundamental problem actually with the way monetary policy works, and that is that recessions are by their very nature unforecastable. They're basically a collective freak out, and that's a very unstable thing that you can never forecast. So therefore monetary policy isn't forced to take into account the consequences of its actions today on what the next recession looks like, because we know another recession is going to happen. There's always another recession. You don't know when it's going to happen. But in Norway, the central bank actually has as one of its objectives to lean into, to counteract the build-up of financial imbalances that might make the next recession worse. So, I mean, there are issues with that. How much should you lean? Doesn't that risk you setting interest rates higher than necessary sometimes? But it would at least force a discussion about what are we doing to the next recession, because the depth of a recession depends very, very much on the degree of silliness that preceded it, how bulletproof everybody felt. And we have definitely gone into the silly zone in the last 2 years, and we are going to pay that price in the next recession, which you will not find in our forecasts. You won't find it in the Reserve Bank's forecast. We're hopeless at seeing recessions coming, but we know they will come. And we know that the asset price appreciation we've had in the last 2 years is going to make that recession worse. Was it worth it? Did we even ask that question? The framework doesn't actually encourage central banks when they're setting policy to think about that bigger picture. It's all about maximising growth in the near term if it's currently too low. Obviously, we're in a different game now where they're trying to dampen growth, but yeah, we've overfilled the hole, and now I'm a little bit worried that we have actually unnecessarily exacerbated the business cycle, and how bad that's going to get, we don't know, but we are currently in quite a fragile situation.
Can I just make a comment there, a relevant comment, Chair?
Yeah.
Is that Sharon's point, in the Reserve Bank legislation, it does actually say that monetary policy shall have regard for financial stability. You know, there's the financial stability objective, and there's the dual mandate. Now, you know, in that major easing that happened in early 2020, there was no mention of the having regard to financial stability. But, you know, this is something you do that the central banks have to think about, and different governors and different central banks think about it in varying degrees. Some put more emphasis on the financial stability aspect. You know, costs of generating extreme asset price movements. And if that had been given more weight in early 2020, you know, maybe that initial major easing would not have been so great when it started to become apparent that housing was going to really take off. I'll just put that in there, that there is that capacity in the framework.
The Governor talks a lot about the least regrets policy, and every time he says it, it worries me a little bit. It was sort of like, just go big and then go bigger, and we'll worry about it later. That's how I interpreted it a little bit. Charles, can I bring you in? I mean, this is not the first time we've had a debate about asset price bubbles and loose monetary conditions. You have Alan Greenspan back in the 90s, and then they had the dot-com bubble. Here we are again, potentially. Do central banks, as a rule, take enough notice of the impact of their decisions on asset prices?
I think that you could suggest that they take too much concern, not all of the central banks, but the Fed in particular. As you mentioned, the Greenspan put, whenever asset prices in the US have gone down really sharply, the Fed has come back from any restrictive policies in order to ensure that asset prices don't collapse too much. And the very fact that financial markets are declining quite sharply after Putin's invasion means, I think, that at the next Fed FOMC, we are almost bound to get 25 basis points rather than 50 basis points, because they don't want to upset markets too much. Because they don't want to upset markets too much, not just out of interest for the markets as such, but if you upset markets too much, you can get a recession. There's always the fear of 1929 at the back of the minds of central bankers. And the very concern about asset markets being too frothy and the likelihood is that from now on there's going to be quite a sharp decline, means that it's going to be very hard for the Fed and for anybody else, any other central bank, really to raise interest rates sufficiently fast to keep a wage price spiral from developing and getting going. And it's a very, very nasty situation. And you want to tell the markets, no, we're not going to support you. In which case, under present circumstances, you could have free fall and recession. Or you effectively say, we're going to do things very gently and we're going to warn the markets every time we're going to move, that sort of thing. And then the likelihood that a wage price spiral will develop is actually quite high.
And aren't we at the point where this is that approach has got completely out of hand? I mean, look at the multiples of share prices on the US stock exchange, the NFT phenomenon, all the other things we could highlight from earlier this year. I think it was the takeaway joint that was worth a couple of $100 million. The whole thing feels like this has all gone a bit too far, doesn't it? And if the Federal Reserve is running scared of upsetting asset markets, then really effectively the Greenspan put continues, and we'll never get back to a more sort of sensible risk allocation matrix, if you like, he said, sounding slightly worried about these things. Sharon, any thoughts from you there?
You can suppress all evidence of risk for a surprisingly long time, but you cannot eliminate risk as a central bank. And so I think people for a long time have thought, the central bank's got our backs, we're all good. But, that risk, that volatility, it gets bottled up and then it explodes. So I don't doubt we're going to get back to a more sustainable and sensible valuation for assets. We may undershoot, but we'll get there because those market forces will not be denied forever. It just could be a bit of an uncomfortable path, as I think we're all on the same page on that one.
I sense that. I think I polled this panel on the likelihood of achieving a soft and gentle landing, it might not fare well with the three of you. Can I get one final word then on the Russia-Ukraine situation? Charles, you've already made the point about the risk of increased commodity prices further in some of the key commodities. Is there a chance, for example, will this make the current situation worse, you think, from a economic perspective? And of course, we're all very worried for the people of Ukraine, and there's a much bigger issue than the immediate sort of economic impacts, but here we are talking about macroeconomics. Or is there a risk actually that it sends the markets into a negative tailspin, which actually alleviates the inflation risk, or at least assists the central banks with the inflation risk? Again, not wishing ill on anybody.
I think the answer is that both are going to happen. Markets are already weakened. I think they're inevitably going to weaken further. But in the short run, this is a massive further adverse supply shock, which sends prices higher. The prices of fertilizer, for example, in the UK, are virtually tripled. You reduce massive wheat exports from Ukraine and Russia, and the prices of basic foodstuffs of flour are going to be shooting up over the next 6 months. I don't see how there's any alternative. And it just makes both the outlook and the problems of market weakness on the one hand and inflation getting out of hand on the other, that much worse. And it's bad news, however you look at it.
Grant and Sharon, particularly from a New Zealand perspective.
Well, it's a terrible event, and it will have significant short-term effects. But being sort of clinical about it from a sort of an historical perspective, if you look at the impact of wars on financial markets, often it can be quite a short, sharp sell-off. I don't have much doubt that the markets are selling off, but it's not major. Obviously, if it blew up into something really more serious and bringing in other countries, then that's a different picture. But the way it's looking now, I would see markets bouncing back. And even now, the market analysts focusing on really, what the Fed's going to do, whether it's going to be starting to adjust from 50 points back to 25 points, and focusing on the policy as opposed to this particular, geopolitical event in Europe.
Okay.
And just one point on the interest rates, in terms of those overvalued assets, that in the recent cycle, the central banks of this world have contributed to zero and negative rates, so they've really exacerbated those elevated asset prices. But underlying that, over the past 20 years, has been a downward secular trend in real interest rates, which has been the underlying driver of the very strong asset prices over the past 10 years and longer. So, I just don't want to exaggerate or overstate the central bank's contribution to this. There are underlying real factors that are driving these markets as well.
Very fair point. Sharon, we'll let you have a final word on any of these topics.
There's so much to talk about. Obviously New Zealand doesn't have much direct trade exposure to Russia or Ukraine, but it does seem likely to boost world oil prices and energy more generally. And it's also hit the New Zealand dollar, so that all adds up to more pressure at the petrol pump. And the Reserve Bank basically said that increase in global inflation pressures was a big driver of why they thought the OCR needed to stay higher, because their framework basically assumes that has the potential to have a persistent impact on inflation expectations. And in this environment, it's very hard to disagree. So in that context, it definitely increases the chance of the Reserve Bank hiking by 50 at some meeting in the future if it persists, because it's going to boost headline inflation. But beyond the near term, it's symptomatic of a world where geopolitical risk is a growing threat, and I think that's going to contribute to a partial unwinding of the globalization, which has been such a deflationary force in the last decade or two. And so I think it just does underpin that we're no longer in a world where inflation needs to be lovingly nurtured. We're in a world where it needs to be smacked on the head regularly, which is in a way back to normal and not entirely bad in that sense. But we've got quite a problem on our hands for now, though, and I think we're all pretty much on the same page that that's going to be a very, very challenging environment for some time yet.
Look, thank you very much, all three of you, for your time. A sobering assessment, but also a very sensible assessment of where things are at. Charles, thank you very much for joining us from London, late in the evening there now, I know. We do appreciate your contribution, and also to Grant and Sharon, thank you very much for joining us on the Economic Forum today.